Hey, everybody, Marty Missouri, good evening. It's the 5th of February 2018 coming at you once again. Second video in a couple of days. Our view of the conditions of the market, the condition of the economy, the technical backdrop, and so forth. We view this as healthy volatility even now, even after how extreme it feels. You're going to have another blog post in your email inbox very shortly. I referenced last night's analysis from a research provider of ours, Bespoke Investment Group. They are going to provide evidence, historical evidence, that suggests, as we've been suggesting, that the selling probably isn't over just yet. It may be close. We don't think it matters in the long-term scheme of things. We think it could go down markedly lower and still be within the context of an ongoing bull market. And we'll continue to show you why we think that way, if indeed it does continue. But I'm going to want you to read that blog post because I think all of this helps put it into perspective. But tonight I wanted to interact with you just a bit here on my chart. This one won't take too long. You have in front of you pretty much the extent of the decline, the last 7 trading days. Up here you can see the sectors that we have exposure to, for the most part, not each one of these, but these are sectors that we certainly do have exposure to from time to time, many of them currently. Consumer staples are down 6.8% over the last 7 days, utilities down 3.8%. Industrials down 6.6, technology down 6.5, healthcare down 7, telecom down 5, energy 10, materials 9, consumer discretionary 5.5, financials call it 7, almost 7 for the S&P, 7 for global commodities, 5 for REITs, 6 for global telecom. Interesting that the two areas that have been just getting killed, utilities and REITs, have actually done better, and that was really as of today. Which is interesting because the narrative is that stocks are freaking out because of the potential for higher interest rates and inflation. This is actually just today being a completely risk-off, somewhat safety-on trade, and that's really what happened today, was that the defensive stuff actually did better than the cyclical stuff. Again, the S&P down about 7, developed foreign down 7, emerging markets down 7, Asia Pacific down 7, Eurozone down 7. Gold down just a bit. It did come back today, which makes some sense to me given kind of the extreme nature of the sell-off. Silver still down 3%. Bonds, 20-year plus Treasury ETF down 2.7. Dollar actually gained a little ground last 7 days. Copper still up. Industrial commodities, the group that we track, dead even. So pretty dramatic for the last 7 days. But again, you're going to see in the written post that you're going to get in a little bit that this is the 4th time during the current bull market that we've actually had 7+% declines over just a 7-day period. Now let's work backward a little bit. Let's go year to date. On a year to date basis, consumer staples are down 4, utilities down 7, industrials down just 1.6, tech almost a dead heat, healthcare pretty much even on the year, telecom down 3.7, energy down 4, materials down 4, consumer discretionary up 3.4, financials flat, S&P 500 down just 1%, global commodity producers down 1.1, REITs down 7, global telecom down 3.8. So again, here's the defensive stuff really taking it to the chin relative to the cyclical stuff. Again, the S&P 500, developed foreign down 1, emerging up 1.7, Asia Pacific down 1.3, Eurozone flat on the year. Gold up 3%, silver flat, bonds getting killed down 5, dollar down, copper down 1%, industrial materials as a group up 2. So if I told you at the beginning of the year, after such a good 2017, that the market would be down 1%, a little over a month in, I don't think you'd even think twice about that. It's just how we got here that makes you think, of course, twice about that. Let's look at the last year. Last year, we are 1 year, staples up 3.2, utilities flat as a pancake, industrials up 16, technology up 25, healthcare up 16, telecom down 10, energy down 4, materials up 12, discretionary up 21, financials up 18, S&P up 15, global commodities up 12. Folks, the bigger Gainers are the areas that we have the biggest exposure to. So in spite of what we just experienced over the last week, still really, really good gains over the last year. And I would argue that we still have a very favorable economic backdrop. In fact, it's gotten better of late. It's just that I think that has the market freaking out a little bit because of the prospects for inflation and higher interest rates. And as we've discussed on the blog already, quants in this market, program traders, they had their algorithms set for divergences between bonds and stocks, and then just some automatic unwinding of positions, short volatility, et cetera, which is very dangerous. It's been a very good trade up until this week. So we had some extreme positions that have to get unwound. I think there's some more unwinding to do before things settle down and get better, but there's nothing here, even this volatility, that makes us think that we're on the verge of the next bear market. And of course, we will keep you posted. Thank you again for watching and listening. And of course, we'll be back with more very soon. Take care.